Okay, let's get straight into it. Welcome everyone to this deep dive, especially for you if you're gearing up for that ACCA financial reporting exam.
Yeah, hello. We've got your study materials here, and we're focusing today on a really key bit, IAS 37.
That's the one. Provisions, contingent liabilities, and contingent assets.
Exactly. Our aim is basically to unpack the core stuff,
Mm-hmm.
defining these things and figuring out the rules for recognition and measurement.
Sounds good. So IAS 37 sets the scene. Your notes stress this difference right up front, don't they, between provisions and contingencies?
Absolutely critical. Um, think of it like this. A provision is a liability. You know you owe something, but maybe he's not sure exactly when or how much. There's an obligation there.
Okay, so it is a liability.
Yes.
Yeah.
But a contingent liability, that's different. It's only a possible obligation. Its very existence depends on some future event.
Ah, right. So the certainty level is the key differentiator.
Precisely. And that difference dictates everything that follows, whether you book it or just talk about it in the notes.
Gotcha. So for provisions, the more certain ones they can go on the balance sheet, but only if they meet certain tests, right? What are those?
Yeah, there are three, and you need all of them. First up, a present obligation from a past event.
Present obligation.
That can be legal, like a contract, or constructive.
Exactly. Constructive is where your actions or policies create a valid expectation you'll pay up. Second, it needs to be probable that you'll actually have to pay out.
Probable meaning more likely than not, like over 50%.
That's the general benchmark, yes,
Yeah.
more likely than not. And third, you need to be able to make a reliable estimate of the amount.
A reliable estimate. So no wild guesses?
Nope. Needs a solid basis. Miss any one of those three, and it's not a provision you recognize.
Okay, present obligation, probable outflow, reliable estimate. Makes sense. So assuming you tick all those boxes, how do you measure it? Put a number on it.
You measure it at the best estimate of what you think it'll cost to settle it right at the reporting date.
Okay.
You have to factor in risks and uncertainties.
Okay, best estimate. And crucially, if the payment is quite far off, you have to think about the time value of money.
Ah, discounting. So you bring the future cost back to today's value.
You got it. You record that present value initially. Then each year, you kind of unwind that discount. That bit hits the income statement as a finance cost.
And the provision amount goes up over time back towards the expected settlement amount.
Exactly. Plus, you need to review the estimate each year and adjust if things change. And don't forget potential reimbursements and the disclosures in the notes.
Right. Lots to consider there. Okay, let's flip to the other side, the contingent items. Liabilities and assets. How are
Yeah.
they treated?
Well, this is where prudence really kicks in. For contingent liabilities, those possible obligations, you don't recognize them on the balance sheet.
So just disclosure.
Disclosure in the notes, yeah. Unless the chance of paying out is really remote, then you might not even need to disclose.
Okay. And what about contingent assets? Potential good news.
Even stricter, you only disclose a contingent asset if the inflow of benefits is probable again, that 50% hurdle.
But you don't recognize it as an asset then.
No, recognition only happens if the inflow becomes virtually certain. Much, much higher bar than for liabilities. The standard is very cautious about recognizing potential gains.
That makes sense, conservatism. Now, your study guides mention specific examples like future losses, onerous contracts, restructuring. How do these fit in?
It always comes back to those three core recognition criteria for provisions. Take future operating losses.
Right.
You never provide for those.
Yeah.
Why? Because there's no present obligation from a past event. They relate to the future.
Okay, that's clear. What about an onerous contract?
That's where the unavoidable costs of fulfilling the contract are more than the benefits you expect to get back.
So you're locked into a loss-making deal.
Pretty much. And if that situation meets the three criteria, present obligation from signing the contract, probable outflow because it's loss-making, reliable estimate of the loss, then you recognize a provision.
So the same logic applies across all these specific scenarios, restructuring, decommissioning, etc. You just apply the tests.
That's the key takeaway. Understand those three criteria, understand probability, and you can analyze pretty much any situation IAS 37 throws at you.
Okay, great. So to quickly recap, we've looked at IAS 37, the vital difference between provisions and contingencies, the three tests for recognizing provisions, how to measure them, and how contingencies are handled differently through disclosure, mainly.
Yeah, it really hinges on meeting those criteria and hitting the right probability levels probable for provision recognition and disclosure of contingent assets, virtually certain for contingent asset recognition.
Right. So as you continue your revision, here's a final thought to consider, building on what we've discussed.
Go on.
How does that inherent subjectivity in words like probable or needing a reliable estimate actually play out in practice? Think about how two different companies facing maybe similar situations could end up with quite different provisions on their books, and what that might mean when you're trying to compare them.
That's a really good point. That judgment element is huge in applying IAS 37 in the real world, something definitely worth mulling over.